Good day, Junior Tikkies. I'm Mrs. Brimacombe. In Activity 2, we're going to focus now on the liquidity financial indicators. Liquidity means, can the business pay off its debts without any problems in the short term? Will we be able to meet our short-term obligations? In order to control working capital effectively, the business must ensure there are enough liquid funds, meaning cash, to settle the current debts, which is our creditors, when required. Stock is sold in a reasonable period. Cash is collected from debtors within a reasonable period, and that's normally 30 days. Any surplus liquid funds not immediately required, we need to invest that, because if we invest that, we can generate an additional income from that. So you need to know that when we're talking about our working capital, is the business liquid? We're looking at our current assets and our current liabilities. And you should know by now, if you know your formats, the current assets consist out of inventories, trade and other receivables, cash and cash equivalents. My current liabilities consist out of your trade and other payables and your bank overdraft. The financial indicators that forms part of your liquidity is your current ratio, and your current ratio we're looking at, will we be able to meet our short-term obligations? Does our current assets exceed our current liabilities? Asset test ratio, if we take inventory out of the equation, would we still be able to meet our short-term obligations? Stock turnover rate, how many times per year do we turn over our stock? And our stock holding period, how long do we keep our stock? Do we have enough stock? Average debtors collection period, how long does it take our debtors to pay us? Average creditors payment period, how long does it take us to pay our suppliers? So those are the 6 financial indicators which forms part of your liquidity. And it's so important to understand that and study that, because you could be asked, comment on the liquidity. Then you need to know which financial indicators to use. Now, when we look at these 6 financial indicators, we can comment on it by comparing last year's figures with this year's figures, indicate if there's an improvement or not, give an opinion. But then we also can group them together, and this is what I call the BFFs. Now, BFFs is best friends forever. So my first BFF is my current ratio and my asset test ratio. So we're looking at, will the business be able to meet their short-term obligations? Then we're looking at our current ratio. But if we take trading stock out of the equation, would we still be able to meet our short-term obligations? That's where the asset test ratio comes into play. Then my second BFFs, best friends forever, is my average debtors and my average creditors payment. We're looking at, do we collect money from our debtors before we pay our suppliers? And then my next BFF is my stock turnover rate and stock holding period. So this means that the quicker I turn over my stock, the less period of time I'm going to keep my stock. So those 2 are BFFs, and they are long distance friends with the asset test ratio. And why do I say that? Because if there's an improvement in your stock turnover rate, in your stock holding period, it means that I'm selling my stock much faster. That means that my asset test ratio will show an improvement. The following information was extracted from the records of JH Kitchen Supplies. The business is owned by partner James and Hallmark. They supply home appliances. Required, so we need to prepare the statement of financial position on 31 July 2022. 2.2, calculate the asset test ratio and then comment on the current ratio and the asset test ratio. 2.3, The total sales were 2,299,500 for the year ended 31 July 2022. 80% of goods are sold on credit. So we need to calculate the debtors collection period. Does the business have effective control over their debtors? Quote figures to support your answer. Give the partners advice to improve the situation. 2.4. The business buys from suppliers in China. It takes on average 20 days for stock to be delivered from China. The cost of sales was 4,200 per day. How long will it take the business to sell their closing stock, which is currently on hand? Do you think that the business does have enough stock? Explain using figures to support your answer. Then 2.5, partner Hallmark is of the opinion that the business is selling stock much quicker. Quote 2 financial indicators to support his opinion. And then the last question, the total credit purchases were 1,379,700. Calculate the creditor's payment period and comment on the payment to our creditors. They provided you information A, extract from the trial balance on 31 July 2022, additional information, and then extract from the statement of financial position on 31 July 2021, which is the end of last year. Then information D, financial indicators. Question 2.1, completing the statement of financial position. So our step number 1 is to take the balances from the balance sheet account section and take it where it's supposed to go in your balance sheet or statement of financial position. Make sure that you show your calculations in brackets. This is easy marks to get. Now take note. My current account, James, debit. A debit means negative. A credit means positive. This is why we need to indicate minus 23,000 plus 58,000. Make sure fixed deposit that you name or mention or write down the name of the bank. So this is the easy part to get, marks to get, is to know exactly where am I supposed to take trade debtors, trading stock, bank. Bank is a question mark, which means we will need to solve that. Accrued income, income received in advance, prepaid expense, and creditors control. This is why you need to make sure that you study your formats. If you don't study your formats and you put it in the wrong places, you're going to end up losing marks. The business has one manager who earned 274,800 per annum. He received a salary increase of 1,800 from the 1st of February 2022. The business decided to employ another manager on the 1st of July 2022, earning the same monthly salary after the increase. So this means that we need to find out, but what is the monthly salary that this manager earned so that we can calculate, and this is after the increase, so that we can calculate the new manager's salary. Now, if we look at this adjustment, the new manager was left out of the salaries journal in error. The manager will get paid on the 5th of August 2022. That is outside of my accounting period. Starting now with our calculation to find out but what is the monthly salary after the increase. The salary was increased with 1,800 from the 1st of February 2022. Our accounting period ends 31 July 2022. So from February until July is equivalent to 6 months. So this means August to January is equivalent to 6 months as well, because per annum, 12 months. He received a salary for 12 months for this accounting period. So when we're starting with the calculation now, we are going to step number 1, find out what was the total increase amount. He earned 1,800 more, so 1,800 times 6 equals 10,800. Now we're going to deduct that from the total he earned in that year. So 274,800 minus 10,800 equals his salary for 12 months without any increases. So if we divide it by 12, that is the monthly salary before the increase plus 1,800 means after the increase he earned 23,800. And the new manager is going to earn the same monthly fee after the increase of this manager. They said the details of the salary is as follows. SARS pay-as-you-earn, 18% on gross. Pension fund, 15% on gross. UIF, 1% on gross. This means if we're looking at our total deductions, 15% is my pension fund, 1% is my UIF, 18% is my pay-as-you-earn. That is equivalent to 34% that will be deducted from his salary. So the total deductions is 23,800 times 34% equals 8,092. This means that his net salary will be 23,800 times 66 over 100. And that is how much we owe the employee after the deductions. When we're completing the statement of financial position, we need to find out what is the net salary if we owe our employee. The gross salary will always appear in your statement of comprehensive income. In my statement of financial position, it will reflect the net salary plus the deductions plus the contributions which is paid over to that specific fund account. This means trade and other payables, we're going to take the net salary, 15,708, plus the deductions, 8,092, that equals 23,800. You could have written it separately as well. It gives you exactly the same answer. Do not forget to add the next part. The business contributes to the pension fund and the UIF on a rand-for-rand basis. The new manager was left out. The manager will get paid on the 5th of August. This means that we still need to add the contributions, which is my UIF and the pension fund. To find out the UIF and pension contributions, we're going to take the gross salary and we can say times 16 over 100. You can calculate 23,800 times 15% for pension fund. And then you can calculate 23,800 times 1% for the UIF. They haven't asked you to complete the notes to the statement of financial position. We're only completing the main part. It's recorded directly under trade and other payables. So I can say 23,800 times 16 over 100. And that is my UIF and my pension contributions. And that must now be added to the trade and other payables. Number 2, stock taking took place on 25th July 2022 and the physical stock determined as 175,000. However, on 26 and 27 July, the following stock transactions took place after stock taking. One of the employees who are employed part-time is owed wages of 1,800 for the last week in July. On the partner's permission, he had taken trading stock at cost for 750. The balance will be settled by the business in July. Credit purchases, 36,422. These transactions were omitted the stock take figure must still be adjusted. So if we're looking now at our trading stock account, there was an opening balance, 172,000. That was the list of balances which was given. According to the physical stock take, which was determined, we had 175,000 of trading stock left over, which means that there was a difference of 3,000. We had more left over than what the trading stock reflected, which means there was a trading stock surplus. So we are going to add the 3,000 to the 172,000. But now we will need to adjust that 175,000 because after the stock take, there were adjustments. There were transactions that took place which was not yet recorded. And the first one was one of the employees who were owed his wages of 1,800 for the last week in July. And on the partner's permission, he had taken trading stock at a cost of 750. The balance must be settled by the business in July. So the first step is we need to show that stock was taken by the employee. He took trading stock and the value of that trading stock was 750, which means trading stock is going to be credited. So we need to show minus 750 under inventories. But now we need to show that this employee was owed 1,800. But because he took trading stock to the value of 750, it means trading stock would have been credited and creditors for wages would have been debited, which means our liability will decrease with 750. So 1,800 minus 750 is how much we actually owe this employee. The next transaction which was omitted was credit purchases of trading stock. It means that trading stock is going to be debited, which means that our assets will increase, and creditors control is going to be credited, which means our liabilities will increase. Third adjustment, a debtor whose debt had been written off previously honored the amount of 2,800 on 20 June 2022. This transaction was recorded, but on the credit side of debtors control. It means that we've incorrectly credited debtors. This person is no longer a debtor to the business. It should have been bad debts recovered. So we need to correct debtors control. And to correct your debtors control, it will need to be debited. And as soon as debtors control is debited, we need to add 2,800 so that the correct account could have been credited, which would have been your bad debts recovered. Please take note, if you are battling to know should I plus or should I minus, then use the T accounts as a tool to see what is it that what I'm supposed to be doing. The next adjustment, loan repayments were made during the year. These have been recorded. The total interest for the financial year is 44,800 according to the loan statement. Interest is capitalized, which means it's added to the loan account. In the next financial year, the loan repayments, excluding interest, will be 8,500 per month. So starting with my loan, we are going to add the interest 44,800. Now, whatever is paid in the next financial year must be taken out of our long-term, out of our non-current, and taken to your current portion of loan. They said 8,500 per month. This means we will need to times that by 12 to know what is the total amount that will be paid in the next 12 months. This amount must now be subtracted from your non-current liabilities. So the total loan amount is 358,000. Make sure that those two figures are the same. Included in the cash and cash equivalents is 1/3 of the fixed deposit, which will mature in September 2023. So if we take 150,000 and we say times 1 divided by 3, it means that 50,000 will mature in the next financial year. And that must go to your cash and cash equivalent. So the total which will appear as part of your fixed deposit is 150,000 minus 50,000. Now that we've completed all the adjustments, we can finish the statement of financial position by closing all the brackets, calculate your inventories, trade and other receivables. Then we need to go on to our capital and reserves, our owner's equity. Our total capital was 1.4 million. My current accounts, 35,000. Which means my total owner's equity is capital plus the current account. Then we can solve our trade and other payables, which means our total current liabilities is my trade and other payables plus the current portion of loan. Owner's equity plus non-current liabilities plus current liabilities equals my total equity and liabilities. You should know that your total equity and liabilities must be equal to your total assets. Now I'm sitting with a problem. I don't know what's my tangible assets or my fixed assets. That's still unknown. And my bank had a question mark. My cash and cash equivalent is still unknown. This means we need to now look at our financial indicators. There's a reason why they provided the financial indicators to us. So looking at these indicators, I can use the current ratio or the assets ratio to solve my current assets section. So if we look at our current ratio, it's your current assets divided by your current liabilities. If you've calculated your current liabilities and you've got the current liabilities, you can use that. They provided the current ratio to you so that you can find out what is your current assets. Take your current liabilities times 1,8. That equals current assets. Once you've got your current assets, your total cash and cash equivalents becomes now the balancing figure. Now we can solve the bank, which was a question mark. Total assets minus current liabilities equals your non-current assets. The balancing figure is my fixed assets. Looking now at the financial indicators and the commenting, the next part of this question. 2.2. Calculate the assets ratio for the year ended 31 July 2022. Comment on the current ratio and the assets ratio. So starting with, we need to now use our calculations or our amounts that we've calculated in the statement of financial position. To calculate the assets ratio, it's your current assets minus inventories divided by your current liabilities. Or you can take your trade and other receivables plus your cash and cash equivalents divided by the current liabilities. If we take our current assets minus our inventories divided by the current liabilities, our assets ratio is 1,03 to 1. Now to comment on these two indicators. Starting with the assets ratio, quote the indicator or mention the indicator, quote the figures. The asset test ratio improved from 0,8 to 1 to 1,03 to 1 in 2022. So I'm quoting the figures and I'm indicating the trend. If we're looking at the current ratio, it improved from 1,2 to 1 to 1,8 to 1 in 2022. This means that the business is liquid. They would be able to meet their short-term obligations without selling their stock. Question 2.3. The total sales were 2,299,500 for the year ended 31 July 2022. 80% of goods are sold on credit. When we're calculating the debtors collection period, we must take our credit sales. Do not take your total sales. Sales consist out of cash and credit. We want to see what is the collection from our debtors, those customers who bought on credit. That's why we need to find out our credit sales. So step number 1, to find out your credit sales, we are going to take the total sales times 80%. Total debtors for 2022. This is now where you need to make sure that you use the correct figures. It's 169,800. That was your debtors control balance plus the 2,800. That equals 172,600. This is your debtors for 2022. Now we can calculate our debtors collection period by taking your average debtor, which means debtors, which means the beginning, plus the end, divided by 2. End of last year was 257,000, and this year 172,600. If we take 214,800 divided by the credit sales, 1,839,600, it means that the number of days is 42.6 days. Now, does the business have effective control over the debtors? Quote figures to support your answer. No. Why? The debtors collection period increased from 32.5 days in 2021 to 42.6 days in 2022. So it means it's taking debtors longer to pay us back. Advice: give discount to customers for early settlement of account. Charge interest on overdue accounts. Send SMS reminders and send statements out before the end of the month. Ensure that debtors do not exceed their credit limit. So these are measures that we can put in place so that we can collect the money quicker from our debtors. 2.4. The business buys from suppliers in China. It takes an average 20 days for stock to be delivered from China. The cost of sales was 4,200 per day. How long will it take the business to sell their closing stock, which is currently on hand? Do you think that the business does have enough stock? Explain using figures to support your answer. So this is quite a challenging question. We need to use the figures which was now calculated in the statement of financial position. Now they provided the cost of sales per day. But if we were now to calculate the total cost of sales, we need to find out what is the sales. We need to know what is the markup percentage. So our total sales were given to us in question 2.3. The markup percentage was given, it's 50%. So to work out the cost, we're going to take the sales times 100 divided by 150. Now, if you are given the cost of sales per day and you times that by 365 days, that will also provide us with the total cost of sales. They specifically said, how long will it take the business to sell their closing stock, which means we need to use the total of our inventories. That is our closing stock at the end. 210,672 divided by my cost of sales times 365 equals 50.2 days. If you take your closing stock and you divide it by the cost of sales per day, it will also provide you with that same amount of time. So now, do you think that the business have enough stock? Yes. It takes on average 20 days of stock to be delivered. The business does have enough stock for 50.2 days. The business will need to ensure that they order stock within the next 25 days to ensure that they will have enough stock. So just to quickly recap, when we're looking at the stock turnover rate, the stock holding period, it is your average stock divided by your cost of sales. So we first needed to find out the cost of sales. The easiest to find your cost of sales, if they provided the cost of sales per day, we're going to times that by 365 days. Take your closing stock divided by cost of sales times 365. That is how many days of stock do you have left over. Question 2.5, Partner Hallmark is of the opinion that the business is selling stock much quicker. Quote 2 financial indicators to support his opinion. So our options is our stock holding period and stock turnover rate. If we look at our stock holding period, it improved from 66.4 days to 68.8 days. 60.8 days. Why is that an improvement? Because we're keeping our stock for less amount of time. We are selling it faster, and you can see that if you look at the stock turnover rate, it increased from 5.5 times to 6 times. If that number goes up, it means that we're selling our stock faster, which means that we're keeping it for less number of days. They are converting their stock quicker into cash. Question 2.6. Calculate, or the total credit purchases were 1,379,700. Calculate the creditors payment period and comment on the payment to our creditors. So to work out the creditors payment period, we need to know what is our average creditors divided by credit purchases times 365. So the first step is to work out your creditors control. You can't just take the trade and other payables figures. Your creditors control is the 89,000 plus the 36,422. That was from the list of balances given, and this was the credit purchases of trading stock which was not yet recorded. Now we can take the balance end of last year, the balance end of this year, so we need to add it together, divided by 2 to get the average creditors. Once we've got the average creditors, we're going to divide it by the credit purchases times 365. That is how long it's taking us to pay our creditors. To comment on this, we need to compare it to last year. So if we're looking at last year we paid our creditors, it was 25 days. Now it increased from 25 to 37.5 days. So quote the figures and indicate the trend. Now you give your opinion. This is more satisfactory as our suppliers were paid too soon in 2021. This was probably to take advantage of discount for early settlement. And this is what I spoke about earlier when I said about the BFFs. If we just look at the creditors payment last year, we paid our suppliers before we got money in from our debtors. Now, if we compare that to this year, creditors are still being paid before the business collects money from the debtors. The business can improve the cash flow if they pay creditors after they receive money from debtors, as long as the business stays within the credit terms of the suppliers and do not occur interest for late payments. So all of these questions was targeted on looking at how do I comment on those 6 financial indicators and how to calculate the financial indicators. Make sure again that you study when you hear the word liquidity, that you know exactly which financial indicators will form part of that. Next, we are going to look at activity 3. I want to leave you with this quote: success comes to those who act. Have a wonderful day.